Just which way is the world economy headed? If you look at the stock market, there's probably just about as many bulls as there are bears. But there are other worrying signs who make people talk about a double-dip recession. Welcome to Agenda, and joining me this week is Peter Zeihan. Peter, there are many people now who are quite optimistic about the future, but on the other hand, in the United States, the jobs market is struggling, and the investor Warren Buffett is talking about recession still being with us. What do you think?
Well, the recession most certainly is over. The question is whether or not we're headed for a second one. There are 5 statistics that Stratfor looks at to determine the strength of the American market. And ultimately, when you're looking at the global system, you must understand what the American consumer is up to. The American consumer market is a $10 trillion business. The global consumer market is only about $20 trillion. So if you can figure out what the Americans are up to, what the Americans are feeling, what the Americans will do, you'll have your picture. You'll be able to figure out where the rest of the system is going to go.
So what do these figures actually tell us?
The first factor is bank credit. Put simply, if banks are not willing to extend credit to consumers and businesses, there's no point in even talking about an economic recovery. Now, bank credit for this entire recessionary period has actually been contracting, but in the last 3 months, we see the first increase that is not as a result of government intervention. That's some of the best news that we have had in 3 years. And so, first factor, bank credit, very forward-looking, looking positive. Second, we look at the balance between inventory levels and retail sales. Inventory is a measure of how many goods are stocked up in warehouses or on retail shelves. It's a very forward-looking indicator because if you have very strong inventories but you don't have good retail sales, it means you have a buildup of goods. Whenever you have a buildup of goods, it means that retailers don't have to place orders for more. In that situation, employment 6 months out, 12 months out tends to get very weak. Retail sales are kind of the flip side. They show you exactly what happened, but it takes a long time to gather the data, about 6 weeks. So all the data is about 6 weeks old. So it's kind of a lagging indicator showing where the consumer has been. The balance between these two determines the employment situation in the midterm. Right now, you'll notice that inventories are up, indicating that economic growth in the future will be a little bit weaker. Retail sales are also up, but not by nearly as much. So we have a little bit of an imbalance. It's a mixed picture at best. If anything, it's probably slightly recessionary. And so this is one of the things that we're worried about. The consumer just isn't seeming to keep up with the inventories. That's a problem. On the next chart, we have the S&P 500 index. This is probably the only one of the headline figures that you've heard of that we actually use at Stratfor. The S&P indicates what investors are thinking, and more importantly, what investors are actually doing, what they believe. As you can see, the S&P for the last 6 months has been relatively flat. And so just as in last quarter, in this quarter, investors are just kind of holding their breath waiting. If we had to take a stab at it, we'd say they're waiting to see what the elections are going to do. Everybody is concerned about what taxes are going to be. Everyone is concerned what government and spending is going to be. And the first solid insight that we're going to have into that is going to be in the first week of November. At that point, we'll know what the balance between the Democrats and the Republicans are, and people can start making some educated guesses based on that. The other line on this chart is the unemployment figure. This is first-time unemployment figures here in the United States. People who have lost their jobs and for the first time are going to apply for state assistance. Like the S&P line, it's pretty much been flat for several months now. This is a lagging indicator. It shows us that potential consumers, people who have jobs, are feeling a little nervous about the future. What you want is for it to slope generally down after a recession. And for the first year and a half, after the recession's peak, it did exactly that, but it's been holding at the same level now for about 9 months. And so we've got 5 factors, only one of which is truly positive, 3 which are mixed, and the other one, retail sales, is slightly recessionary.
Let's just go back to this question of bank lending, because on the one hand, the Fed kept interest rates on hold, but on the other side of the equation, we have regulators across the world tightening the screws on banks and perhaps making it more difficult for them to lend.
Well, see, that's the interesting thing. Despite all the regulations that have kicked in the last 6 months, bank lending for the last 3 months is actually positive. That indicates that at least at some level, corporate America is feeling relatively confident about the future. And right now, that's the best example we have of positive American sentiment. Now, something to remember about Americans is that they're moody. Americans as a culture are manic depressive. It comes from being a settler society and every year pushing inland and finding more and better land. We're used to things getting better every year, and when they don't, we go a little cuckoo, we start to overreact. That affects our foreign policy, that affects our consumer spending. It also means that until we have incontrovertible evidence that things are better, we're going to believe that they're worse.
What about China? We had a surprisingly downbeat assessment this week from none other than the Premier, Wen Xiaobo.
It's a degree of honesty from a politician who realizes that he's probably in his final year in government, and he can speak a little bit more honestly. The Chinese government has been pushing for years to split away from the dollar, to develop a consumer market, to kind of hive themselves off from the U.S. economically. We now know that they haven't been serious about trying. The Chinese government, all of their efforts to generate a deep consumer-based economy has only given them an economy, a domestic economy roughly the size of Spain, maybe France at the height. That's roughly 1/6 the size of the American consumer market. If they continue efforts at the rate they're going, before they can get to a point that they've got a similar proportion of their economy consumer-driven, internal-driven, not dependent on the U.S. system, it's going to be another half century. You don't grow this sort of thing overnight.
And I noticed that leading academics in China are now saying what Stratfor's been saying for some time, that the economy there is very unbalanced.
The Chinese system is, if we give everybody a job, they won't rebel. And so in the United States, in the West, savings are used to fuel investment, investment is used to fuel trade. In China, savings are used to encourage employment, and employment revenues are used to further encourage employment. It is not a tactic that encourages a high rate of return on capital. It is not a tactic that encourages profit. It is a tactic that makes sure that the citizenry is sufficiently happy that they don't overthrow their government. China's not concerned with profit. They're not concerned with economic growth even, except for as it allows them to employ more people. And the problem they're going to face in the mid to long term is exactly the same problem that brought the Japanese economy to its knees in 1991. All of these loans that allow this system to function, that give everybody a job, are eventually going to be called to the carpet. And when that happens, the whole thing comes down like a house of cards.
Well, we've talked about the two big economies, but are we seeing anything significant emerging from any other countries?
The one that is most interesting right now, the most dynamic one by far, is Germany. Germany has an interesting demographic. We always talk about the aging baby boomers in the United States, but something like that is happening in every developed country in the world. Germany's big generation, the big bulge in their demographic profile, is in their 45 to 50-year-olds, 40 to 50-year-old, that area. People who are mature workers, who don't have a lot of debt, who own their house, and are saving for retirement, but they're still about 10 years away. That age group is when you're going to be at your most efficient in terms of production. And the Germans have a lot of them. And they don't have a lot of children. Their demographic profile just kind of narrows in after that point. So they're not spending a lot on education, but they are getting a huge amount of productivity out of their workforce. Add in the economic problems, the financial problems that the Europeans are having, and you have this state that is hyper-competitive within Europe, but now because of the weak euro, is hyper-competitive globally. Nobody can compete with the Germans right now. And so they have managed to take their command of industry and their ability to outcompete everyone locally, and now they're outcompeting absolutely everyone.
Peter Zeihan there, ending this week's agenda. I'm Colin Chapman. Thanks for being with me. Until the next time, goodbye.